Gavin Parry, the MD of the eponymous named Parry International Trading. You got some recent calls right, Gav. To be honest, the RRR rates cut, no one forecast that. Bit of a surprise. You were forecasting it for a couple of weeks.
Well, I mean, one of the major aspects has been the interbank lending rate in China. I mean, Shibor is still basically about 3 months to 6 months is about 5 to 5.5%. And literally, one of the factors of that, as I said last week, is the lower household deposits savings rate in China, which effectively is affording the banks not to have cheap access to capital. And even though the PBOC has been doing open market activity in the 1 year to try and help things, basically the interbank lending rate's still been maintaining high because they just haven't had access to the capital.
How would you sum up this year so far, and then advising people investors going to the last month of the year?
Well, we still think that we do.
High?
No, we still do think we grind higher. It was an interesting call from a strategist in the UK actually 2 days ago saying that if the ECB doesn't buy bonds, you should dig a hole and hide. I think the difference out here in Asia is the fact that the governments have been proactive. They've been front-loading the easing, so it's basically been the dog as opposed to the tail wagging the dog, which is more the European situation at the moment. Some key factors that we will be looking for Q1 is basically extension of the tax cuts in the US and also subsidies for the jobless. If we don't get those in Q1 next year, then we could have some big impacts to GDP in the States.
You've got the jobs figures out, 125,000 on the payrolls number for November, and 9% unemployment. It's pretty high still. Is it going to be a big number come Monday morning for our reaction, do you think? It always is, obviously, but I mean, is this one particularly sensitive?
Yeah, it's. I mean, we still think the US slowly grinds higher in relation to economic data. We think that activity still continues to grow, and that the focus will swing back to US slow expansion and China easing. One of the main things we do need to see is a further decrease in the borrowing costs for euro-US dollar. Obviously, we had that cut, which was an organised operation by central banks. But if you put it in perspective, it basically dropped to about 131.5 basis points. So that's the 3-month euro to US dollar swap rate. But in 2008, when we had the crisis hit, it basically peaked at 209 basis points, and then through the crisis of 2008, it got down to about 110. So at 131, we're still very much in a stress zone for the banks in relation to funding.
If you were to put your boat, your house, everything, all your savings onto a couple of trades, so just faceless drops, next year, I mean, how bleak is it going to be, and what would you be investing in? Go for cash, stay safe, or take a bit of risk?
Well, again, there's a few factors. One is the...
hard question, to be fair.
Yeah, no, it is, because there are a lot of factors at the moment. I do think markets still focus on macro as opposed to looking at the individual company aspect. And we've seen that...
Focus too much, do you think?
Well, I mean, we saw it 2 days ago here in Hong Kong when a PBOC advisor came out and said, oh, well, look, in relation to moderate doesn't mean easing. And, the HSI tanked, the Nikkei tanked, and then we basically all kind of rebounded again. And then yesterday with the RRR cut, it was exactly the same momentum on the macro basis. The big factors we will be watching are, again, in Q1, whether the tax cuts are extended and whether the jobless subsidies are extended. The interbank euro-US 3-month, whether those borrowing costs do keep decreasing. I mean, that's a key factor for Europe at the moment. Effectively, by cutting those, we've kind of decelerated towards the cliff, and that cliff is going to be a decision time. But markets will actually keep pressuring politicians in Europe to make a concrete decision to get this situation done. So, in the interim, we still see basically, markets grinding higher. The one thing that is interesting is people are talking about maybe a QE3 coming. We're already in a QE3. I mean, basically for permanent open market activities. For Q4, the Fed's on track to basically already purchase $60 billion worth of mortgage-backed securities. So if they would have done a lot more if the economic data in the States hadn't been okay and stable. So in Q1, if we don't have those things happen, if economic data does drop down, we may see an official QE3, which really will be a QE 3.5 of an official mortgage-backed security, as opposed to QE2, which was $100 billion in treasuries.
Gavin Parry, thanks for coming in there. Good advice there.